Welcome back to Getting Digital with Deja, and today we're going to be talking about how to borrow against your life insurance policy. This is part 2 on how the rich stay rich, and that's because they borrow against their life insurance policies. They know how to use their money to benefit them because in reality, you're putting a premium into your life insurance policy every single month. No matter if it's high, if it's low, medium, whatever it is, you're paying every single month. Don't you want to be able to benefit off of that money that you're paying? Like before you die? So, a common misconception that people have is that you have to die for your life insurance policy to mean anything, for you to benefit off of it at all. But how do you benefit off of a life insurance policy? Let's be real. If you're dead, your family will benefit off of it, your state will benefit off of it, but you as an individual, how do you benefit off of it? You're literally dead. We're going to talk about how you can benefit off of it while you're alive and thriving. So I'm not going to lie, this isn't going to be a very long video because I'm not like a life insurance guru, but I do like know the foundation of it. So I'm going to share it with you guys because I did recently get a life insurance policy. Okay, but I'm going to share with you guys the knowledge that I picked up on while the process of me getting it. So to be able to do something like this, you'll need a permanent life insurance policy that has a built-up cash value. And the quickest way to have a higher built-up cash value is a universal life insurance policy. So a portion of your premium that you pay every month goes towards your life insurance policy, like your death benefit, and then another portion of it goes towards your cash value. You also have something called a variable life insurance policy, and that's where you can use like your policy to invest inside stocks and things like that, and that also builds up a quicker cash value inside of your policy. So you really just have to kind of do your research and see which one works for you and the assets and what you're trying to achieve, but they're both really good and you can both borrow against them. And if you're a corporate girly or a corporate guy, kudos to you, because more than likely if you're a full-time employee, your employer offers life insurance policy for you and you don't even have to pay for it because it's like of a group life insurance policy, and it's usually equal to your salary that you get for the year. So if you get paid $150,000 a year, your life insurance policy could possibly be $150,000 and you don't even have to pay a premium to like every month, okay? Or if you do have to pay a premium based on your employer, it's going to be at a highly discounted rate because it's not just an individual life insurance policy, it's through your employer, which is covering all of the employees, so it's considered a group life insurance policy. So that premium is going to be so much lower, but you're still going to have access to your money, if that makes sense. Like, catch my vibe, stay with me, I'll explain. So the higher your premium, the more money you'll be able to borrow at a faster rate. So if your premium's like $50 a month, it might take you a little bit longer to build your account to where if your premium was $200 a month. Now, I know $200 a month for life insurance is kind of insane, but if you have it, why not? Because you'll eventually be able to borrow against it. So all the money that you put into it, you'll be able to literally just kind of like take it out without having to die. So some people might not agree with this statement, but I kind of view life insurance policies as like a secured credit card, because with secured credit cards, you put in a certain amount of money and you take from it and you pay it back. So if you have a secure line of credit for $20,000, you deposited $20,000 inside of that account, okay? But now you're just kind of like borrowing it. So it's like you take out of it and then you pay it back. You take out of it, you pay it back. So I feel like that's kind of very similar to the logic behind a life insurance policy when you're trying to take out a loan, is because you're literally borrowing against your own money. So of course, it's not exactly like a secured credit card because you're not going to be taking out loans and paying it back. No, that's not what you're going to do. Like, most likely you'll probably like take out one loan, two loans. I think there's probably a limit based on whoever is your insurer. But it's not like a credit card to where you can be like, okay, I need some money, I'm going to take it out of my insurance policy every single month. Like, you might be able to do that with some people, but I just don't really see what the purpose would be for that. Like, just do a large sum at one time. And the reason why I kind of say this is better than a margin loan is because, first of all, it's tax-free. As long as it's within standing and it's still ongoing, like you don't cancel your policy or anything, it's tax-free. And then the second thing is you can choose to repay it, on your own timing with interest, or you can choose to have it taken out of your death benefit. So you're not necessarily paying the loan back. So that's why I kind of feel like this is better than a margin loan. Pay a pretty good premium and you'll be able to borrow against that pretty soon. So after a bit of time, and let me tell you, it doesn't have to be a long time. It just kind of like depends on how much cash value it accumulates, because usually before you can take out money out of your life insurance policy, it has to be between $500 and $2,000 depending on which company you go with. But it has to be in that range before you can go ahead and request a loan to take out some of that money. And you can take out up to 90% of that money of your cash value on your life insurance policy. So now we're getting to the juicy part, the cons of borrowing against your life insurance policy. So the first con is that it does take away from your death benefit amount. So it takes away from the money that goes towards your kids or your beneficiaries or your estate and things like that. And that kind of defeats the purpose of a life insurance policy if you don't really have nothing left to give to your beneficiaries when you're gone. But that is something that, if it works, it works. If it doesn't, it doesn't. It's all up to how much money you want to leave your people when you're gone. But to combat that con, that's only if you don't pay it back. Like if you just borrow and you don't pay it back, that's that case. But if you borrow it and pay it back, then that money does go towards your death benefit, and so you will have something left to leave to your beneficiaries. So the second con, in my opinion, the biggest con, is a policy lapse. So that's when you have an outstanding loan balance plus you have the accumulated interest on top of that. If that outdoes, it outnumbers your cash value in your account, your policy will be terminated, and that's when they call it lapse, and you'll be responsible to pay all of that back, and you'll be responsible for the taxes and just it'll go on your credit. So one way to combat that is risk management. I have to do risk management every day in trading. We have to do risk management every day in life, honestly, because most of us aren't just free to spend money all willy-nilly. We have bills that we have to pay. So I feel like you just have to practice really good risk management and money management when trying to take out a loan against your life insurance policy. But if you're not good with that, I don't suggest that you take this route, because it's a very dangerous game if you don't pay it back. And so, like I said, this was going to be a short video today because I'm not an insurance guru. I just kind of wanted to give you the ins and outs of it, and you do your own research on what benefits you the most. But borrowing against your life insurance policy is really great, and I cannot stress this enough, you guys. Get a life insurance policy. Even if you don't plan on borrowing against it, get a life insurance policy, okay? Especially if you have children. And then on top of that, get health insurance. Please get health insurance. Now, I'm not really sure about borrowing against your health insurance, but I just feel like everybody needs health insurance because anything could happen and you don't want to be set behind because God forbid something, you get into a car accident or something. God forbid, okay? God forbid. And you don't necessarily have the money to pay for those expensive surgeries and stuff or hospital visits. A hospital visit can cost you $200 just to see the doctor. And you don't have the money right now to do that. You don't want to put yourself in debt because you weren't able to pay for that of something unexpected that can happen at any time. So just go ahead and cover yourself, pay the little bit of money a month, and you can also get health insurance through your employer if you're working full-time, if you're a corporate girly or a corporate guy. Y'all, if you're going to work in the corporate world, you need to use all the little benefits that they give you. You need to eat them up. Eat it up, okay? Vision insurance, dental, health, maternity leave, all of that. Eat it up. Eat it up. And to close the video out, guys, I want to let you know that pretty girls can do finances too.